Hello, everyone. Welcome to today's PENTalk. I'm Beth Parker with Pentegra. We're glad you joined us today. We're pleased to present our new study on bank retirement and executive benefit trends. I have a few housekeeping items to review before we get started. If you have any questions during the presentation, please submit them through the question box located on the control panel on your screen. We'll answer as many questions as time allows, as we want to ensure we are respectful of your schedule and end on time. If we don't get to your question today, we'll definitely follow up with you afterwards. Stored on your control panel in the handout section is a copy of today's presentation along with a copy of our study. I invite you to download these resources now or at any point during the webinar. I'm excited to introduce today's expert, Chuck Caldwell, National Director, Consulting and BOLI Services. Chuck oversees our consulting, marketing and communications, and BOLI practice areas. He works closely with Pentegra's teams to develop strategic initiatives designed to enrich the client and participant experience and meet the ongoing needs of clients. He also leads our BOLI business development efforts, working with clients to design customized strategies for benefit financing using BOLI. Chuck, hello and welcome to this month's PENTalk. Let's get started.
Well, thanks very much, Beth, and good afternoon all, and thanks for joining our latest PENTalk discussion, which is going to cover a recent survey we conducted with our bank clients on retirement and executive benefit trends. We conducted this survey in the first quarter of 2019, and the results are based on responses we've received from our bank clients. And it's no surprise that attracting and retaining employees continues to be one of the biggest challenges faced by all employers today. When it comes down to it, it's really benefit packages, the perks, your work-life balance. They're all key elements in your total rewards and compensation packages. And designing an effective retirement program is a big piece of your overall benefit package. One of the things that you're going to want to do as you look at your benefit packages is to determine what kind of a philosophy you have when putting together a competitive package. And one of the things that we want to talk about today are the philosophies that you can select in coming up with a benefits package. And really it boils down to two principal approaches. You can use an objective approach or a competitive approach. And frankly, most clients and banks that we talk to today are really using a combination of the two. So they do different things, and it depends upon what your own individual philosophy is as to which will work better, or whether you want to combine it as most do. So starting with an objective approach, here what you're really looking at is benefit levels or benefit adequacy. And you're analyzing a level of compensation and a level of benefits that help employees at the end of the day maintain their standard of living in retirement. So that's looking at a level of benefit. And many clients do use that approach. The other approach is a competitive approach. And in banks, obviously, you're in a very competitive marketplace. It matters what your peers are doing. And putting together a benefit package, knowing what your competition is doing, weighs very heavily on most of our clients and their analyses of their benefit approach. So one of the questions we asked was, how many of you are doing which kind of an approach? The survey selected either the objective approach or the competitive approach or both. And looking at the two separate approaches, I think the majority of banks were using the competitive approach versus the objective. That is what your peers are doing. But you can see the highest percentage there, just shy of 40%. We're actually using a combination of both. So it does matter what your peers are doing, your competition is doing, but obviously in the back of most people's minds is we're trying to reach an objective, and that is, can we help our employees retire and maintain that standard of living in retirement. Ultimately, what this is all about is employee retention, attracting the right employees, and having a strong benefits package is really one of the keys to maintaining a solid staff. The point on this slide is very important. We all know benefit packages are expensive, especially if you're maintaining either an ESOP or a defined benefit plan. Your health programs aren't getting any cheaper. But replacing an employee can even be more costly. And that's what you really have to balance. We've been to a number of recent bank conferences, and we get to hear all kinds of vendors talk about the importance of attracting and retaining employees. And I'll tell you, one of the experiences I had recently was listening to a panel of millennials. And it was very interesting. They were asked a simple question: what attracts you? What keeps you at banks? And I'll filter some of their responses in as we go through this presentation, but it was an eye-opener because they look at the world a little differently. But bottom line is, it was the people. Ultimately, when you're putting together a package, you're trying to retain your people. And one of the most interesting comments that came out of that survey that I was listening to was it was the people. That a millennial might stay at a job that isn't necessarily their favorite, but if the people they worked with were making a difference, if they were nice to work with, they were supportive, they would stay at a job that even wasn't necessarily the one they saw themselves in. And that's very important to me. You want to find employees that you can attract and retain and keep for the long term. That's the key. So let's get down into some of the weeds. Here we're talking about retirement benefits, one part of your package. So we thought we would ask the question, how important do you feel retirement benefits are in attracting and retaining people? And this is confirming certainly our thought process. Is nearly 80% of respondents thought that retirement benefits were extremely or very important. And that's telling. And I'll mention this too. One of the things that came out of this more recent discussion with millennials was they do think long term. They're planners. So the long term matters to these folks. I remember a few years ago we were thinking about the newest generations were perhaps a little short on attention spans, my words, and we're not really thinking long term. Short term is what mattered. Well, I was very glad to hear from this more recent group that they are thinking long term. And that's certainly what a retirement plan positions you, is trying to take care of your staff long term. And that certainly helps in terms of the retention of staff. The next question we were asking was rank the goals of your benefits program. What are you trying to accomplish? I mean, obviously, when it comes to retirement, you're trying to accomplish maintaining a standard of living in retirement. But looking at your whole program, what are we trying to accomplish? Well, the first goal, which got the most attention, was putting together a retirement package that was competitive. And that kind of fits into the thought process of many banks using the competitive approach as a benefits philosophy. Improving overall compensation. That was the number 2 goal. Reducing administrative responsibilities. Certainly when it comes to a retirement program, there are many administrative responsibilities on both the employer side and the vendor side. It's hard to get around them when you have to comply with various things like ERISA and IRS and DOL regulations. Minimizing risk. That was brought to the forefront of many people's minds. And I think over the last year and a half, we've seen that in the industry that risk mitigation and fiduciary liability at the same time are important concepts. And certainly, I don't know about your own banks, but certainly many of our clients are always looking at ways to make the programs more cost-effective, reduce costs, either by redesigning programs or looking at benefit financing tools to help with the costs. So these things, again, are all important as you look at designing and maintaining these types of programs. So after a kind of a generic overview of retirement packages, we get down into what types of retirement plans do banks maintain. And you can start with the much larger category called qualified plans. And IRS qualified plans certainly are a critical element of any package. Those are your 401k plans, your pensions, your 401k profit sharing plans, your ESOPs. And a qualified plan allows the employer to deduct the contributions being made to the plan. So obviously, the more contributions going into a plan or plans, the greater the tax deduction. If you want to look at a downside of qualified plans, is you have to provide them uniformly to all your eligible people. And you have to comply with various ERISA and IRS and DOL regulations. Your qualified plans generally fall into two categories: defined benefit plans and defined contribution plans. Your defined benefit plans are the pension plans. They can be traditional plans. They can be cash balance plans. You've probably heard of that term. They can be defined contribution plans, which really cover the 401k and profit sharing plans of the world. And at the same time, you can do a combination. We have many clients that maintain more than one type of retirement program and combine a pension plan and a 401k, or perhaps they have a 401k and an ESOP. So maintaining multiple plans is not unusual at all. They do different things. They achieve different goals. As you look at your defined benefit plans, and certainly this is no surprise to anybody, but over the last 20 to 30 years, defined benefit plans have shrunk in the number of employers who maintain them and participants who are covered by them. There's still about 20% of America that maintains a defined benefit plan. But one of the benefits of a pension program versus your 401k plans and anything that's a defined contribution plan is it provides a known level of income. And it provides that income generally at no cost, most plans, no cost to the participant, and no market risk to the participant, which is why I love talking to our clients who have both a defined benefit and defined contribution plan, because the participants have the best of both worlds. They get a known level of income, which really is a base level of income for them in retirement, and then they have their 401k on top of it where they have market risk, they manage the assets. So the combination is really good for the employee for sure. And it's interesting, despite the fact that defined benefit plans have been in decline in so many years, we've actually had a number of clients who have put a soft freeze on their defined benefit pension plan, which means you simply are going to exclude new hires. Existing staff continue to earn the benefit, new hires do not. And we've had a couple, including Pentegra itself, who had soft freezes and then unfroze them. Why? One client, for example, was looking to hire middle management people. That was their bread and butter. I'm going to say the over 35 to 45 crowd, and they found they weren't able to attract the kind of people they wanted. So they unfroze the plan and started it up again and found they were able to attract the kinds of people they really wanted. Pentegra is a perfect example too. We had a soft freeze when I first came back to Pentegra in 2011. So new employees were not being enrolled in the plan. And we finally figured out that we could do a couple of things. Number one is we could open this up again to everybody, which we did, with a different design. We went from the traditional formula-based defined benefit pension plan to a cash balance plan. And if some of you are familiar with cash balance, it is a low-cost retirement program And there's no magic bullet here. It's low cost because the benefit levels are lower. But we accomplished a couple things all at once. We were able to open the plan up to everybody, include all new hires. We have a defined benefit plan to go in conjunction with the 401k plan here at Pentegra. We were able to significantly reduce costs. And at the same time, those of you who have defined benefit pension plans, you are probably aware of there's annual non-discrimination testing that has to be passed each year. And anytime you soft freeze, that is, you exclude new hires, you're going to have a difficult time in the years ahead in perhaps passing those tests. So we were able to solve that problem at the same time because we're not excluding anybody. So again, when you look at qualified plans, they generally fall into these two categories: defined benefit and defined contribution. Why does an employer provide a qualified plan? Well, again, it's the tax side of the equation where all the contributions that the employer makes up to maximum tax deductible contributions are tax deductible. And obviously, these are sizable contributions go under these types of plans. So the tax benefits are significant. And that's obviously a driving force to maintaining these types of programs. So obviously, the next question was, all right, you maintain a qualified plan. What type of plan do you maintain? And no surprise, I think, to anybody on the phone, about 80% of our respondents maintain a 401k plan. Profit sharing. Well, profit sharing was around long before 401k, and frankly, a 401k plan is a type of profit sharing plan. It's qualified as a profit sharing plan. But this category that you see on the screen, profit sharing, was, here's a plan, they're non-employee contributions. It's a year-by-year decision by the employer as to how much they wish to contribute. That does not mandate contributions. So profit sharing gives the employer a ton of flexibility when it comes to contribution levels. Your ESOPs and KSOPs are stock-based programs, heavily invested in employer stock as an investment vehicle. And then at the bottom here, you can see pension and cash balance. Pension refers to your traditional pension plan, which is formula-based. Your cash balance is still a pension plan, a defined benefit pension plan, but it looks and smells more like a defined contribution plan in that there's a hypothetical account balance. The contributions are not based on a formula. They're based on salary percentages and an earnings rate. So today, if I just added the last two categories, pension and cash balance, you'd find that we have about 25 to 30% of our respondents still maintaining some sort of defined benefit pension plan. So once you take a look at a qualified plan, and that's, I think, where everybody should start, that is a program, again, that covers all eligible people. The other side of this is what we call non-qualified plans. And your non-qualified plans are much more targeted to participants. That is, you can't discriminate when you start covering and offering a qualified plan. You can with a non-qualified plan. And I say that because non-qualified plans are meant to benefit your executive levels, your directors, you're highly compensated. And again, the downside from the employer standpoint is it's non-qualified because you don't have to meet all the ERISA regulations and IRS and DOL regulations. And you can pick and choose who you want to cover. The downside is, from the employer standpoint, you don't get any kind of tax deductions until you actually pay the benefit. So these can expand the scope of a benefits package. And we'll take a little deeper dive as to the non-qualified plans as to what kind of distinguishes them from your qualified plans. One of the things that you'll find is so many of our qualified plans, your pension and your 401k, use base salary only as a definition of compensation. And you can have a wide range of definitions, but base salary is very typical. So in clients that have base pay under their qualified plans, one of the things they often look at on a non-qualified basis is using total compensation and picking up that piece that's missing under the qualified plan and adding it into their non-qualified plan. Here at Pentegra, one of the things that we did to start the non-qualified benefits under Pentegra's program was we knew the IRS limits on benefits and contribution levels were limiting the highly compensated. You have compliance rules under 401k, which can result in refunds to your highly compensated people. Here, this type of non-qualified plan, we call it a benefit equalization plan, was put in place to simply make somebody whole who was being impacted by the IRS limits on qualified plans. So that was a significant and frequent design. Certainly to defer compensation is a major reason why non-qualified plans are offered. And often what we see is it's simply a perk. It's simply a supplemental executive retirement plan, or SERP, very typical in the industry, is provided to execs simply to increase their ultimate retirement benefits. So logically, the next question for this group was to say, what types of non-qualified plans do you maintain? And you can see that just over 40% are using a supplemental executive retirement plan. So when you see those words, that typically means we're simply providing an additional benefit to some portion of highly compensated people. The benefit equalization plan I mentioned earlier, a lot of Pentegra clients do utilize it, less so in the industry as a whole. And deferred comp was probably the second most frequent arrangement. And under a deferred comp arrangement, what you have to be very careful of is how the money gets invested and who controls the investment. Because theoretically, the exec or the director cannot have complete control over how that money is invested. So what you'll see is in many plans, there is a deferred comp arrangement where there are investment vehicles being offered, at least on paper, and these are really referred to as deemed investment elections for your participants. It's really the employer that has put that menu together for their participants and gives them some control over how that money gets invested. And there are other deferred comp arrangements where it's totally directed by the employer. I've seen them in a single type of rabbi trust where it's simply a CD or some other kind of fixed investment that is the sole investment behind that deferred comp arrangement. And a lot of times, these plans are totally unfunded. They're nothing more than a promise to pay the exec or the director down the road, and no assets are set aside whatsoever. I'd say probably 50% of the plans out there are totally unfunded. But it does give the employer a second vehicle to help round out the total package of benefits, especially for the execs. So obviously we asked what types of plans were in place, but we also wanted to know why. Why did a bank offer these types of plans? And the number one response was competition. It's what our competitive banks do. We compete for the same talent. We have to be on par with our peer groups. It comes to no surprise that I think today in negotiating, especially when you're hiring CEOs or C-suite employees, is those employees come to expect that these benefits exist. So I think most banks feel that that's a have-to-have in their benefit program. They are a very key and effective tool for attracting that top talent. I was a little surprised myself in reading number 3 here when it's referring to top millennial talent, only because millennials are young. Typically at that point in time when they're hired, they would not be eligible for these type of plans. But as I said earlier, the millennials are thinking long term, and I think this was being answered in that in the thought process that I'm going to be here a while. And having that is something I can strive to achieve to become eligible for. And therefore it helps in my retention. So before I get into this bank-owned life insurance, again, just a quick summary. You have qualified plans in the retirement business. You have non-qualified plans. They do different things. They have different tax advantages. Within the qualified plans, you have defined benefit and defined contribution. They have different objectives. One of the things that everyone has to understand is defined contribution plans are vogue. They're in vogue. They're based on career average salaries. Okay, contributions go in every year based on my salary that exists that year. Over the long term, that's a career average plan. Your pension plans historically have been final pay plans. They provide much greater benefits at greater cost. But as people move from defined benefit to defined contribution, I don't think anybody should be fooling themselves that they're providing a similar type program when they go to defined contribution, because you're not. You save money, but you're also reduce benefits significantly. So once you've decided on your benefits package, part of it is obviously cost. What level of cost can the bank afford, and how are they going to pay for it? And that's where this bank-owned life insurance comes in. I think probably most of you have heard of BOLI. It's been around since the 80s. It's an insurance product. It's a very cost-effective strategy to offset benefit expense. And the OCC, when they came out with their earlier bulletin on guidelines around purchasing this, one of the things they said is it's really important that banks are not buying BOLI simply for the additional yield that can come out of that asset. They want it tied to benefit expense or some long-term liability. And that's why you've seen it typically tied to non-qualified plans. Many of our clients tie it to pension contributions or 401k employer contributions, because long-term retirement is in the bank's best interest. So very quickly, I'm not going to turn anybody into an expert on bank-owned life insurance, but because we're talking about benefit expense, knowing that you have other tools that can help pay for that expense, I think is important. So in a nutshell, what does BOLI do? Bank-owned life insurance is an insurance purchase. It's a single premium insurance purchase. The bank pays the premium, you own the policies, the bank owns the assets as well. And the theory here is you are insuring a group of employees and or directors. Typically, this is life insurance, so there's life insurance on each of these people. And typically, at least in our world, a portion of that life insurance benefit is shared with those employees or directors. The real benefit is the tax-deferred earnings. So there's a spread currently in today's marketplace between short-term investments and BOLI returns of probably 2.5% to 3% as a spread. But in addition to that spread are the tax-free death benefits that are collected upon the death of an insured. And again, the bulk of that death benefit typically goes back to the bank, with some level of it being shared with the beneficiaries. And certainly it's a combination of the tax-deferred basis of that income and the death proceeds that really make this an attractive financing tool. So once BOLI's explained, obviously the question was, how many of you maintain it? And no surprise here either. You're talking 70 to 75% of the banks maintain BOLI, with a little more than 20% not providing it. Next question was, if you're not maintaining it, why not? Typically, it comes down to, for whatever reason, management and or the board are opposed to it. Lack of liquidity is an issue. You got to have bank liquidity in order to purchase this. Why are people opposed to it? Well, it is a long-term asset. It stays on the bank's books for a long time. All those policies are meant to be held until death. So I think the combination of the fact that it's a long-term asset does scare some of the banks away from getting into this. And certainly if you don't have the liquidity, it's not something you're going to do. Then we asked the question of those who are using it, what are you using it for? And the number one answer, no surprise, to offset the cost of employee benefit programs. That is what your regulators want you to do. They want you to tie it into a long-term asset. So it's good to see that that's the number one response. but it is a life insurance program. So supplemental life insurance is being provided. It's certainly a tax advantage. Diversification down below there, the bank's asset portfolio. That's one of the key elements as well. And one of the things that it can do, and one of the reasons people do buy BOLI, is it can more effectively provide group term insurance, which is a side advantage to it. Well, listen, I've taken my half an hour. I appreciate you listening. I hope you come back and listen to our future Pen Talks. This has been a discussion of recent trends in retirement and benefit packages. And after all, the level and quality of your customer service and the profitability of your organization is really dependent upon your employees. It's what you put in place to attract and retain employees that can be a difference maker. So that being said, if anybody has questions, there is a question box there. You can put them in. I'll take questions if you have any. Otherwise, again, I'm just going to thank you for listening and hope you come back to a future Pen Talk.
Thanks, Chuck. Thanks for giving us that information. We currently only have one question. It was, do you think millennials would have answered the survey questions differently?
That's a great question. And I was happy to have the opportunity to be at a bank conference this past June and listening to 4 millennials answer those questions. And so the answer is yes. When millennials look at employment, I think they're looking at it differently. They are looking at it long term, and that's a good thing. But what's important to them, I think they just assume that banks and employers are going to have 401k plans. They're going to have health care. And what I got out of that discussion that I listened to back in June was work-life balance is one of the most important things to this group of employees. They enjoy work, but they want to enjoy life at the same time. And striking that balance is really key. So when employment flexibility is key, being able to work from home. It was funny, we were all nicely dressed as bankers and vendors at this, and they came in their pajamas and T-shirts and jeans and sneakers, and that's what they wanted. I don't know how that fits into your philosophies, but that's the way they look at life. What's important is the quality of their work, their dedication to the job, and for that, they want the flexibility. So yes, long-winded response to say they would have answered this differently.
All right, well, that's all the questions we had at this time. Everyone will receive a follow-up email where you can respond and ask additional questions if you have any. So thanks again, Chuck, and thanks everyone for joining us today.
Yes, thanks, Al.
Yeah, have a good rest of the day.
You too.